Hi, this is Ronnie, and I'm going to say something about the session which is analyze and assess the financial performance and stability of a business. And we are actually we have another session which is understand the financial implication and capital investment decisions. We will talk this in the next session, but today we're going to discuss about the financial implications of assess the financial performance and stability of a business, and advanced finance for business managers, and this is level 5 course, and the learning outcome of today's session is assess the financial performance and stability of a business. And then at the end of the session we can understand the structure and purpose of main financial statements, and then we can analyze different kinds of accounts, especially the income statements and statements of financial position, which is typically called the balance sheet, to anticipate the future performance of a business. And we can analyze company accounts by using ratio analysis. That's the parameter, or that's the performance measurement for the accounts, as well as for the company. And then we can explain why business needs to manage financial information. So these are the overall scopes of the session today, and then we can start regarding why we produce accounts for the business, and what are the main accounting statements, and who uses this kind of accounts and different types of accounting, and how can we analyze and decide a strategic decision from this accounting and financial information. Basically, we produce accounts to record our financial transaction and to make it informative for the internal and external stakeholders, because that's the record, that's the kind of reporting. As we tell that to provide information for users, internal and external stakeholders, and today we will identify who were the internal stakeholders and who were the external stakeholders to make this economic decision from this financial and accounting information, and to provide a record of how a business has performed financially over the time. That's why we produce accounts. And then we have a different kinds of interested party who can take this information for their business or decision making. Typically we do have different kind of financial information in recording system. That's a profit and loss account, balance sheet, cash flow statement and forecasting, and the ratio analysis. So these are the main accounting performance we can assure to our business to provide accounting information. So basically we need a profit when we do any business or service, and the concept of profit is always we deduct the cost from the revenue. Here we can take one simple exercise, how we calculate the profit from one business. So for example, Mr. Jack decides to use eBay for a business, new business, and he buys 6 sweaters. He purchases 6 sweaters from Crosby Blob, wholesaler, for £10 each, and then the total cost of the sweaters of 6 is £60. And then he thinks he can sell all of these sweaters, £15, and he is thinking that he can do the straight with a profit £5 from each sweater. But this is not true, because he has some overhead costs, and we need to identify what is the different kinds of profit. That's called gross profit, net profit, profit before tax, profit before interest, retained profit. So if this is the simple things, £60 cost of the purchase of 6 sweaters, and then he can sell them off for £15 each. So how many sweaters does he need to sell to get his money back? And he thinks he sells all the sweaters, so how much profit has he made? Okay, so as we can say that there are the different kinds of profits in the business. So actually he incurs cost of eBay listing cost £12 in total and delivery postage of £1.50 per sweater. So net profit definitely the different, and then what it make any difference if a customer pays a week time, that's the accounts receivable or accounts. If the Jack wants to pay later, that's accounts payable. So for income statement, that's a basic one, because Jack purchases 6 sweaters, 6 sweaters, £10 is that's the cost, total cost, and he sells £15 of 6 sweaters, that's the 19 pound. So gross profit is £30, but this is not the actual, the other profit, because he has got some cost of goods sold here, like postage, £1.50 of each sweater, and the eBay cost, that's service using cost, and then he can have a £21 extra overhead cost. So we need to deduct this overhead from the profit. So that's the net profit, £9. So gross profit is £30, but the net profit is £9. So as we can see, there's a different kinds of profit. So final income statement, there's this is income statement. That information provides different kinds of profit from the income or sales or revenue. Now, these are actually the measurement of the calculation of the income statement, or we can say the profit and loss account. This is called P&L account. That's the profit and loss account. And then when we deduct the operating cost from the sales, that's come our gross profit. And then the final profit. So that's typical, actually, the figure of the profit and loss account. So how it works from an income statement to the balance sheet. So when you have a balance sheet or a statement of financial position, that's called your assets and liabilities position. So if you have a last year in assets and liabilities position, then you can make a comparison from this year, and then you can have the comparison from the next year. So if you have a consecutive years of information, and then you are able to do for the different comparison and contrast from the different years, from the income statements and the cash flow forecast, budgets, and statement of financial position. So that's the reason why we need accounting and financial information in terms of reporting, and then we can compare and contrast from the different years. So who uses this information and for what? So we have stakeholders, which are primary. Now let's see who are the primary stakeholders. Definitely the main owners are the primary stakeholders. The management committee, staff, customers, suppliers, competitors, governments, and pressure groups, because they have a direct relationship with the business, and they have some obligation and contractual obligation with the business accounts. Now, definitely we do have an external stakeholder as well, as we see the primary stakeholders. These are the which are directly obligated with the business, and then we have external stakeholders, which are secondary stakeholders, which are the environmentals, local residents, local schools, local authority, competing business, highway authority, police, potential local. These, they don't have a direct relationship with the business, but they have some indirect interest, which is ultimately affects the financial position of the business, because they need to see what's the profit and what's the income and cost and what type of heads that they are using in the business. So these are the secondary stakeholders, which is non-obligatory, and these are the primary stakeholders. There's a direct relationship and obligation with the business. So that's the conceptual. So these the main concepts of how we calculate the profit. So we do have a profit, revenue less cost. So when we deduct the different kinds of costs from the sales and revenue, then we can have a net profit, gross profit, retained profit, operating profit, and different things. And then the main accounting statements, that what does it show? Income statement showing the profit and loss. That's income statement. And statement of financial position shows the balance sheet, assets and liabilities, different kinds of current and non-current assets and current and non-current liabilities. Cash flow, we did have a session of cash flow that's showing the cash inflow and outflow in the business, and that's the one important statement. And management can see what is the cash position in the business, and we can understand on the basis of contractual and non-contractual contracts by the primary and secondary stakeholders. So concept of profit, if we and then if you understand the gross profit and the net profit, then you can make different kind of strategic decision on the basis of profit. So Jack decides to use eBay for a new business. As we can say, he purchases 15 sweaters from Crosby and then tip for 12 pounds is operating cost. Then he can sell the 25% markup on the cost on how many sweaters does he need to sell to get his money back. Then he sells all the sweaters, so how much profit has he made? That's one kind of strategic decision that we can understand. Then if Jack wants to do the 25% markup cost, and then how many sweaters he needs to sell to get the £60 money back. So let's see how we can calculate it. He actually incurs the cost of eBay. Then if we go for the percentage calculation, that's 8% actually the cost of goods sold, and the delivery postage is £1 per sweater. So net profit, and what it make any difference if a customer pays a week's times or he gets a week's credit on his supplies. So let's see the calculation. So that's the sales, £15 each, 15 sweater, and then £12 is operating cost, and then there is another overhead cost, that's at £33 altogether. And then ultimately the net profit from the 15 sweater is £12. Before it, the gross profit is £45. And the markup, we can calculate, so eBay costs 80% of the total sales, and then that's the markup cost. So that's why he can build up his sales and purchase on the basis of markup, and then he can identify his sales and profits. Now, what is the typical outline of the income statements or profit and loss account? So this is actually the typical income and statements, or you can say it's profit and loss account. In the income statements, we have a sales, and then we have a cost of goods sold. Then when you deduct the cost of goods sold from sales, then we can have a gross profit. So in income statement, you can see the gross profit, operating profit, profit before tax, profit after tax, and retained profit. So these are the different kinds of profit you can have from income statement, because this is a profit analysis, and then on the basis of the different profit, you can have a different kinds of expenses, which is directly related with your business. So when you deduct the different kind of overhead expense like admin and salary, selling, depreciation, then you will get the operating profit, and which is typically called the net profit. And when you deduct the bank interest from your operating profit, then you have a profit before tax. And when you calculate the tax for the year, and then you have a profit after tax, and then you will pay some dividends on the basis of management decision, and then you can have a retained profit for the next year. So these are the different kinds of profits you can have from income statements, and this is the one kind of accounting information, the basic. So when you have an income statement, then you can go for the balance sheet and accounts, or statement of the financial position. So I can show you one typical income statement and balance sheet. One is that what the balance sheet is showing you. So this is the typical balance sheet. So this is the typical income statements, and this is a typical balance sheet. On your balance sheet, you have assets and you have liabilities and capitals. On your assets and the capital and liabilities just must be equal, each together. So asset sides will be equal to your capital and liabilities. That's the accounting equation. And then on your asset side, you have a non-current assets, that's the fixed asset, and then your current asset, which is liquid asset. And then on your liability side, you have a capital, different kinds of share capital, total return profits, loan, current liabilities, and then you have a total capital and liabilities. So these are the typical types of accounting and financial information to perform and to assess the financial stability and performance of the business. Now we will move the ratio analysis, how we can calculate the ratio analysis for the business, and then this is the important mathematical expression from the income statements and the balance sheet to one number to another, and providing a relative comparison, and then the management and then any kind of stakeholders can make any decision and expression on the financial reporting. And this kind of ratios help to link the financial statements together and offer figures that are comparable between companies and across industries and sectors. So ratio, basically we know the ratio is kind of the two dots like this, and then you have one figure here and you have another figure there. So you can compare the numerical figure one number to another. That's the ratio, and then this number will come from your financial statements and income statements and the different kinds of calculation. Then we can analyze and then we can compare to with the standard benchmark of the ratio analysis. There's a different types of ratio analysis. So purpose of the ratio analysis is to identify financial strengths and weaknesses, which is the benchmark. So ratio analysis basically to identify financial position, the strengths, weakness, and then obviously from these strengths and weaknesses you can identify the threats and the opportunities. And then purpose of ratio analysis to understand the financial position of the firm and to analyze forecast and budget the trend compared to history and competition. So you can compare the different years and then you can do the trend analysis. You can forecast the budget and then everything profit. If you have a 10 years or 5 years data, and then you can see the trend analysis and see different budget trends. You can compare to its history, and then you can project it. You can project or forecast the business trend on the behalf of your business. So sources of ratio analysis are definitely income statements, which is PL account, profit and loss account, balance sheet, statement of financial position, and cash flow statement. Sometimes, if you want to do some performance basis on the basis of the staff and employee, so you can take some HR information by, for example, number of staffs, number of females, number of males. So you can have the breakup of the sources of HR information, and then you can employ that sources with the income statements and the balance sheet. There are some limitations of ratio analysis, which is accounting policies is not the same. Sometimes it's problematic if the accounting policy is not sent. A different kind of calculation if happened in the different year, that's not unique, and then that's not the basis of the comparison. And then if you want to do the different types of trade and business, compare the industry different, then that would be problematic because of the size. And sometimes the reporting date, year-end date, or a periodic date will be problematic. You can't compare like January data with the June data because it's a two different seasons, winter and summer. So the year-end date is one of the problem, and the size, growth, and other stages of the company, it will be the problem and the limitations of the ratio analysis. So these are the key management ratios. On the basis of the profit, we have a gross profit ratio, operating profit ratio, net profit ratio, return on capital employed ratio. That's a profitability ratio, and this came from the sources of these ratios, basically the income statements, because these are all the profit ratio. You have You have financial status, a solvency ratio, that's current and quick ratio, and then you can have this from the balance sheet, on the basis of the current asset and the current liabilities. And then you have a activity days ratio, stock days, status days, creditor days. And then you can have employee ratios, which is sales per employee and profit per employee. And this is the one kind of investment ratio in earning per share. You can have this compare the investment per share of the company. Now we can see how can we calculate this kind of ratio, and then where can get the sources of this ratio. So for example, the gross profit, you can have the gross profit amount from your income statements and you can compare it with the sales. So gross profit divided by sales multiply 100, that's the sources income statement, and you can have the sales and the gross profit from the income statements, and the metric is percentage. So when you have this ratio, you have to standardize metric or percentage, otherwise it will say nothing. The net profit margin on your operating profit, that means when you deduct the gross profit, when you deduct the operating expense from the gross profit, that will be your return on sales or the gross profit. And operating profit margin, sometimes it's called operating profit margin or net profit margin. And then you can have this from the income statement and it will metric the percentage. Return on capital employed, when you have a loans, your total loans and then your total assets and current liabilities multiply by 100, that's the capital employed. And then this figure you need to see the balance sheet or statement of the financial position, and that figure you have to take from the income statements, and then you can have to express this return on capital in terms of percentage. So these are the profitability ratio, and then this is the formula, and these are the source of the formula, the figure, and then you can express with the percentage. Next is very important is current and quick ratio. And then before going to the further ratio calculation, we need to say that when you have the result of any ratio, the number is saying nothing. You need to interpret, and then the interpretation tells you what your assumption and what's the position of the business. Because without the interpretation, it cannot be compared, and then what kind of figure you are having it from the accounts or financial reporting. So for example, gross profit measures the production efficiency. When you see the gross profit percentage, it says the production efficiency and reflects the pricing decision from product costing. So on your gross profit percentage, the production management can take the decision on the basis of the product costing and prices decision. That's the production efficiency. And then an indicator of changes in buying prices of raw materials. If the gross profit is decreasing, then what's the cost of the decrease? That's the selling price of finished product or production efficiency. Wages can be increased or decreased. That impacts the gross profit margin. So that's the strategic decision you can have from the gross profit figure, and then it says measures the production efficiency and reflects the pricing decision from product costing. And then it should be stable. The management must see the gross profit should be stable. If it fluctuates, then the management should take the measurement or take the action on the basis of this result. Normally there is no general yardstick, as depends on the industry, size and the growth for the gross profit. And then if we see, this is the interpretation. If you see that there is a 30% gross profit, that means that 70%, that means 100 minus 30, that because it's a percentage, 70% of revenues generated by the firm are used to pay for the cost of goods sold. That's the revenue is generating 70% as by the firm are used to pay for the cost of goods sold for the 30% gross profit. So that's the basic interpretation. So when you have the result of any profitability ratio, then you have to express in terms of language. So what kind of revenues generated and what kind of farms payment are used to pay for the cost of goods sold. Now, next is operating profit ratio, or the profit before interest and tax, or return on sales. You can say different kinds of terminology: return on sales, operating profit, profit before interest and tax. And that there is a standard mark, 10%, but depends on the type of an industry. And then it's very comparative, and then low return. That if it is below the 10%, 2% doesn't necessarily mean a low rate return on capital employed, as if sales volume is very high. And low industry return on sales is indicator of overall competition. So these are kind of, interpretation you need to check with your business and size of the industry. So there's a standard benchmark, 10%, but if it is low or higher, you need to see the size and the sales volume and the overall competition. Now, if it is 18% of your profit before interest, tax, or operating profit, that means £1 of revenues generated 18 pence from, that's 18%. 18 pence is left after deducting the cost of goods sold and operational expenses. These are the interpretation of the net profit or operating profit or return on sales ratios interpretation. So if the results came 18% operating profit, that means every £1 of revenues which is generated there, and then 18 pence, if it is 0.9%, if it is 9%, that will be the 9 pence. If it is 50%, that will be the 50 pence. So that pence is left from every £1, and then that's 18 pence from this figure is left after deducting the cost of goods sold, that's a total figure, and operational expenses on the basis of each £1. So this is the basic interpretation of the operating profit. So you have to be very careful which ratios you are going to calculate and how you are going to interpret this. And next is the very important ratios, financial status or the solvency ratios, and which is from sources balance sheet. And the current assets divided by current liabilities will show you the current ratio, and the standard metric is 2:1. So that means you need to have a close to 2 figure. And then when we have one figure here, then we compare 1:1, because always there is a 1. So that's the ratio. So the standard metric is 2, and you need to compare the estimated figure with this standard. If it is low, that says the firm is not that much solvent to pay its current liabilities. And then if you want to see the more quick or acid test ratio, so when you less stock or inventory from your current ratio, when you take out the stock from the current asset, then we'll have a liquid asset. And then when you divide the liquid asset by current liabilities, then we have a quick ratio, and that is close to be 1. So that's current ratio should be 2, standardized, and the quick ratio is for standard metrics is 1. And what it's saying? It's saying that short-term insolvency, that are adequate short-term assets to cover short-term liabilities. And then current ratio 2, which says that metric is true, but it can taken up to 1.6 to 2. And if it is very high, say for example 3 or 4 or 5, then company may be stable but inefficient to use its current assets. So you can interpret this way. And the liquid assets is close to 1 or 0.6 and above, and it shows the ability to meet very short-term creditors out of short-term money in the bank or due. For example, it depends on the growth size and the industry of the business. A supermarket may have a very low ratio, say about 4, 0.4, which is not the standard metric, but it compensates by a high stock turnover and little or no ratio. So therefore, financial status ratios express the short-term solvency status of the company. That means how quick the company can pay off its short-term obligation. And then you can have this from the current ratio and the quick ratio. So next is activity ratio. The activity ratio measures the rate at which the company is turning over its assets and liabilities. So if you have a car stock, and then that can be taken from the balance sheet, and then cost of goods sold, that can be taken from the income statement, and then you have to multiply with the year, 365 days, and then when you have a number of days, then you have an inventory days. You have a debtors days or receivable days. That means trade debtors. The debtors figures can be collected from the balance sheet and the total sales, and multiply the 365. You have a number of days. That means how many days you can hold to pay, or that's a creditor ratio, and you can allow to receive the payables. So normally the standard is 2 months, 60 days times. The less status days, that months that you have a more cash and the deposit in your accounts or business accounts. And the credited ratios is same, and just opposite, because it's the debtors and sales, and the creditor is creditors and purchase. Normally the cost of sales from the income statements, and then you have to then multiply the 365, and then that implies the number of days. And then when you have a performance to see the sales in terms of employee, that's employee ratio, sales divided by number of employees, that's sales per employee, and then metric is per employee. You can see the figure per employee amount. Operating profit, you can calculate all the types of profit of per employee. Take all different types of profit, and then you just divide it by number of employees. And then this source, you can have different kind of sales, operating profit from the income statements, and then HR notes of the number of employee. This actually shows the simply indicators to look deeper position at the staffing levels with the financial performance of the particular business. Now we can go for one calculation from the income statements and the balance sheet. Before going to calculation the ratio, we can have another strategic ratio, which is called strategic investor ratio or investment ratio, which is earning per share. You can have this earning after tax, after all interest and tax, and you can divide that one with number of shares and issues. And then you can have this figure from the balance sheet. So not easily comparable between the company, because for the interpretation, and then it should say actually the stock exchange, the secondary market relation, should go the growth year on year. So you can see what is the EPS, earning per share, is the pricing in the every year or periodically. So you can have the trend analysis or statistical analysis for any strategic decision. Normally applicable to public companies, and it shows in terms of pence per share. So now we can go for some ratio calculation, how you're going to calculate the ratio. So let's see, there is a one income statements of one hypothetical company. Hypothetical company is called AA, and there's one balance sheet. So this is a 1 year, 2016. On your assignment, you need to do minimum 3 years. You have to choose any kind of public accounts and business, and you can have downloads from the website, and then you can take the profit and loss account and balance sheet. That's the public account. And then you can measure the ratio, as we said and showed that there is a calculation of the ratio analysis, and then you can interpret the ratio for your analysis. Now, let's go for the profitability ratio, which measures the margin of different types of profit and income. So gross profit, I'm using the Excel sheet here, so you can use your calculator, but I can show you how can you use cell reference. So I have these figures, income statements and balance sheet figures. So gross profit margin, as we know, the formula is gross profit divided by sales. That equals gross profit. This is our gross profit. Take that cell divided by, that's our sales. That sales is 320,000. So take that one, and if you press enter, then you have a gross profit, because we interpret with the percentage, sorry. So multiply 100, then you have a 30, that's a 30%. Now, so you can see this is gross profit divided by sales, and I can see this is the sales reference, and that's the gross profit, and that's the sales of the company, and you can have a 30%. Now you have net profit margin, operating profit divided by sales. When you do any calculation in Excel sheet, you always start with the equal sign. So equal sign, that's our net profit. Where is our net profit? That's our net profit, which is our operating profit. Take that one divided by sales, and then it will come. If you click on percentage, it will come that way. So if you click on percentage, that will come that, because I have multiplied with 100, and then you have to take out the 100, and it will come that way straightly. So from your Excel sheet, you can use the percentage, and that will show the percentage directly. So current asset and that ratio come from your balance sheet, because these ratios are mostly widely used ratios, perhaps next to the profitability ratio, and these are the very especially important to the creditors, because these ratios measure the firm's ability to meet its short-term obligations. And then the level of liquidity needed varies from industry, size, growth, and other purpose. And certain industries are most cash intensive than others. And for example, grocery stores will need more cash to buy inventory constantly than the software firms. So the liquidity ratios of companies in these two industries are not comparable to each other. So it is also important to note a company's trend and liquidity ratios over the time. So let's see what's the current ratio of this company. So current asset. So this is the assets, and this is the current asset. The current asset is 30,000. So start with the equal sign. Take the 30,000 divided by current liability. So this is the current liability, total current liability. Take that one. So current liability, this one. So that's close, nearly 8.9. 0.9, I could say 0.9, sorry, because it's 0.88, so we can take the 9. And then current asset divided by current liabilities, but you have to take out the stock from the current asset, that will give you the quick ratio. So here, start with equal sign. Because this is, we need to take out the stock or inventory from the current assets, so we need to use the Bodmas Formula. So first bracket, current asset, and then minus inventory, and then you divide it by your current liabilities. That's your quick ratio, which is 0.3. Now we can interpret these things. you can interpret your current and quick ratio on the basis of standard, because as we said, our standard metric is 2, and then this is point, and that is less than standard, and this is also less than the standard, which is 1 is standard. That is, the firm is not have that much capacity to pay its current short-term liquid obligations. So you can have that interpretation with the standard metrics. So now we are going to calculate the stock days. We are going to calculate the dated days, credited days. So stock, as you can see, these are our stock and inventory. So because this is the two things, we need to multiply the number of days. So we need to use the Bodmas formula. So start with the first bracket, stock, divided by our cost of goods sold. This is our cost of sales. Close the bracket and multiply 100. Oh, sorry, 365, because this is stock days. Need to take the days. So now see, 32.589, that's a fraction. Either you need to give a 32 days or you need to give a 33 days. It's up to you, it's your discretion, but you can't do the fraction days, because we can't do that. So 1.5 days in the business term. Either it should be 32 days or 32 days. So here, because it's 5/8 after the decimal, then we can give the 33 days. So that's the answer, the 32 days. So equal datus. Now I can say, I can calculate the dated days. The datus is here. When we see the current assets, stock, datus, and bank and cash is our current assets. So take the datus, and we have to start with the first bracket, because it's a Bodmas formula. Because it is datus, now we have to take the sales. That's our sales. And then we have to multiply with 365. And hit the enter. Now, as I say that you can't take the fraction amount, so either it's 11 days or 12 days. So from here, because it's after the decimal is below the 5, it's 11 days. So here it is 33 days and this is 11 days. Now, we are going to calculate the credited days. So credited days, when we calculate in Excel sheet, you need to start with the equal sign. The creditors, here is our creditor information. That's the 15,000. The creditor is our current liabilities. Take that creditor, divided our cost of sales. Because we are going to multiply these things with the 365 days, so use the first bracket and then take the multiplication with 365, and then we will get the credited days. That's the 24 days. So these days, because normally debtors and creditors we allow the 60 days, and the stock days, the less days we have, the smoother the sales will perform. So these days, it depends on the activity ratios, and the activity ratios measure the rate at which the company is turning over its assets or liabilities. Now, if the company wants to see its performance compared with its staffing level, so employee ratio helps to see the deeper look. So we have a sales per employee and we have a profit per employee. And the number of employee of this company is 12. This information we have got from the HR. Now, what will be the sales per employee and the profit per employee? When we see the profit per employee here, so we are taking the net profit or operating profit from this ratio calculation. So sales per employee, as we have sales, and so equal sign, start with equal sign sales start with equal sign, and then sales, say this one for the sales figure and divided by our number of employee, that's 12. Or you can type on your own if you have the information from your HR. Then you have a this 26,667. But I rounded this figure in terms of decimals. But if you have the proper decimal figure, so you can have this one like this. So if you want to reduce this decimal things, and then you can use this one, 2 decimal, or you can use a round figure when you evaluate after the decimal things. Then operating profit equals, if you can take gross profit, if it is gross profit per employee, but we are calculating the operating profit. So it should be the operating profit. No, I'm not taking the 2. Equals operating profit divided by number of employee, that's the 12. And then that's our 3,416.7. So if you want to round it, so you can take that way. So that's the figure. So this is the efficiency ratio. If you want to see the staff per employee, profit per employee, so you can do more like, you know, profit before tax per employee, profit after tax per employee, written profit per employee. So you can take this figure, yeah, with the number of employees. Now, earning per share. Always remember, when we take the earning per share, we always take the profit after tax just before the written profit. So you take the profit after tax figure, start with the equal profit after tax, and then you need to divide with the number of share issued. So where you can get this information, number of share issued, if you go to your capital, and then you can see the share capital, and that's a 250,000 shares, and then each share is 20p each. So you need to divide number of share issued. So this number of share is 250,000. So you need to write down here 250,000, and you hit the enter. That's your 9 pence. 9.2 pence. So you can take that 9 pence. See, when you issued a share that was a 20 pence each, 250,000 shares. But now in the capital market, the earning per share is 9 pence. So now you can justify this figure with the consecutive other years, and then you can compare and contrast with your business and management decision. So these are the simple way how you are going to calculate the different kinds of ratios. There are more ratios in the booklet, but in this assignment, I think these are the 5 different kinds of ratio you need to calculate, and you need to download on your assignment the one published account, and then you need to compare minimum 3 years, and I would suggest you need to compare the minimum 5 years, and calculate the ratio analysis of the 5 years, and the gross profit, net profit for the current ratio, quick ratio, activity ratio, efficiency ratio, investment ratio. So if you have any problem to download any kind of public account, you can email me, and then I can sort it out how you're going to do that calculation. So let's talk about some assignment briefing, because you need to go your Moodle area, because this lecture is going to upload it shortly in your Moodle area. and then you have to submit one assignment which covers different kinds of analysis the recent financial performance of your published account, which you are going to download from the website, and the stability of the business by applying appropriate financial measures. So you can take different kinds of key management ratios. We have showed today that the 5 different types of key management ratios, and you need to calculate and interpret those figures and numbers in your assignments. And then you have to say something about anticipation, the future performance of the business. So you can project, forecast something on the basis of your ratio analysis. Or if you want to do some further analysis and take some cash flow statement, if you are able to do that one from the published account. And then more importantly, I want to see why this particular business you downloaded from the website as a published account need to manage financial information and systems in order to gain strategic advantage. So for example, if you see that the current and quick ratio is lower than the standard metrics, if you see that the net profit, which is 10%, is like standard metrics, if it is lower than the standard metrics, then you can say something about kind of strategic advantage or competitive advantage, how to manage financial information and systems to gain the competitive advantage. So more specifically, I want to see in your assignment that you can analyze the different kinds of accounts, for example, the income statements and the balance sheet, and then you can make a comparison for the different years, like 3 years minimum and the maximum 5 years, and then you have to do some financial performance analysis on the basis of the ratio analysis and the stability of the business. So therefore you have to say something in your report, in your assignment, that how the business are performing on the basis of different kinds of activities, on the basis of short-term obligations, current and quick ratio, on the basis of profitability ratio, different kinds of profit, net profit, gross profit, operating profit, profit before tax, profit after tax, return profit, and you have to explain those terms, how you're going to calculate, you calculated those profitability ratios, and what are the implications of this, and the interpretation of these results. And again, you have to say something about the financial performance and the stability, as well as the feasibility of a business by applying appropriate financial measures. That's the ratio analysis. And then you have to discuss how you have calculated those ratios, and then you have to show the formula. Because when you do the ratio analysis, I need to see the calculations of your formula, and then you have to explain. There is an explanation section why this particular kind of business need or forecast to manage financial information and systems in order to gain competitive advantage, or any other kind of strategic decision you're going to make, any suggestions. So recommendation on the basis of your calculation will be appreciated in your assignments. And then for the assignment purpose, you need to email me, and then if you need any query, you always call me to my office. I'm available 10 to 4 at the Versity office, and this is my email address. I'm always regular to pick up your email. So thank you very much, and that's all about today's lesson, and enjoy the financial performance lesson, and I hope for the best. Good luck. Thank you.